Welcome to the Active Advisor Podcast, brought to you by Harbor Capital. Join us as we learn from pros who have helped thousands of investors live better lives. I'm Brian Moore, and I'll be chatting with some of the brightest minds in the financial advisory business, bringing you insights on practice management and investment research that works for advisors and their clients. Joining me today on the Active Advisor Podcast as my fellow colleague and co-host is Dale Corman, CFP and CIMA. Dale is an investment consultant at Harbor, covering the Southeast region of the U.S. Our guest today is Erik Gilman, CFA, CFP. Erik is the Chief Investment Officer at Independent Financial Partners, short for IFP, and the President of IFP Asset Management. Erik has over 15 years of experience in the real estate and investment industries and has leveraged his self-taught Python programming skills to enhance his approach to portfolio management and help his teams reach the next level. Erik, how are you doing today?
Great. Thanks for having me.
We're definitely going to have to dig into the self-taught Python programming skills. That's something that, I've looked at. I'm pretty good at Microsoft Excel, but that's about it. Quick question. What's the first memory you have related to money or investing?
Yeah, so that had to be, leading up to the dot-com bubble. My daddy worked for Hewlett-Packard, sold networking hubs and things like that. And so he got really drawn into the dot-com bubble and, all the internet stocks and, companies without an actual business model or business plan. That's my first memory, is just essentially just learning from that. And that is what drew me into behavioral finance and learning about what are the things that cause people to, overextend and chase the hot dot, and then kind of go after these tech stocks and avoid these massive drawdowns. So I think that's my earliest memory. I think I was like 13 or 12 or so, just kind of sitting next to him while I think E-Trade was the platform we used back then. So kind of interesting overall, but that is my first memory.
Excellent.
Before we get into anything else, you've mentioned to me recently that you have a surgery coming up. And of course, we hope it goes smoothly. But for the audience and fellow pet owners out there, do you want to give maybe a public service announcement as to what not to do post-op when you have a very large dog?
Yeah, I guess I would say if your dog weighs more than 100 pounds, don't worry so much about the picking up of the dog from the surgeon. It's the getting him home that's the tough part. And make sure you stretch.
As somebody who has a 100-pound dog, yes, that is key. May I ask what breed?
Cane Corso for that guy.
Oh, nice.
140 pounds. So, yeah.
Oh, wow.
So I'm getting surgery and he's done with his ACL surgery. So we're trading places.
Oh. Well, I'm glad to hear he's doing better or she's doing better, and good luck in yours.
Thank you.
Wanted to actually circle back to the CIO aspect of your role. So you're the CIO at IFP and the president of IFP Asset, the RA side. Mm-hmm. You recently entered into a strategic venture with the retirement PPP. Wondering if you could actually give us a little bit of background about IFP, your kind of historical affiliation, focus, and then where, you've seen the evolution over the past couple of years and where you're at now.
So we started out as what's called a hybrid RA with LPL Financial. And then in 2019, we broke away and launched our own broker-dealer just so we could kind of control things and really control our own destiny, more or less, and do the things that we want to do and really provide the best experience we can for our advisors. Our advisors are fiercely independent. And so our business model is always kind of a constant pursuit of integrations and fully open architecture. Our objective is to be agnostic to the custodians that our advisors want to use. So ultimately, there's a reason why not everyone does that, because it's a lot of work, a lot of different moving parts and pieces. And in 2019, we launched the broker-dealer. We initially had probably 6 custodians, 1 custodian for the brokerage business. And so we're now in a phase where we've got pretty much everything we need onboarded, although there's new technology in fintech that seems like it comes out every week that we need to evaluate. I think Pontero is the name of the recent one that we just added as well. So, advisors can essentially charge on defined contribution plans without having to do a brokerage window. But, we're always in a constant pursuit where, the traditional ways of running our business and making money really doesn't work well with our business model. So, from things like partners programs and conferences, when our advisors are able to do their own thing and we don't fence them in and make them use like 10 money managers. So we have to do things a little bit differently. And so there's not really a precedent that you can really find or mirror in our industry. So that's what we're constantly trying to do, evaluating other industries. What are some other business models outside of financial services and RAs, the pieces that we can adapt, whether it's Amazon, how they essentially put products and stuff in their marketplace and how they sort them and do things that way and pay for eyeballs and views and things like that, I think is a better approach. And so ultimately, that's the overarching theme in terms of what we've been working on, kind of where we're heading, just the constant refining of that process and business model.
That's great. Appreciate that. And I want to dig a little bit deeper into that. I've known you since you joined IFP over a decade ago. So kind of to back up a little bit and then sort of look forward, what was it that initially drew you to IFP all those years ago? And you talked about this a bit, but what do you see, Aaron, as the primary edge in your business model?
So what brought me to IFP, being the chief investment officer, potentially, when I was 25, I think. So that was the initial part. And then also the ability to really build something from the ground up. I love building things and seeing them work and people actually use them. The main motivator for me is just building things, more of an entrepreneurial mindset. I wasn't really ever drawn to somewhere where I had a defined, path where I was going to make X here, do this for 5 years, and then you make Y and so forth. And you get some prescribed bonuses, kind of like the CPA model where, you have a defined benefit at the end of the road and everything's set for you. I don't like that. I like having kind of uncapped potential on the upside. And so what drew me in, outside of the role itself was just the ability to essentially build something and, potentially reap the benefits and upside. So I don't want to ever be a place where I'm capped, where I have a very refined and a very small set of duties that I have to do day in, day out. I like changing things. I like being able to go home and just kind of think about what I want to build next and, where I want to take this thing. And it's a great environment for it. So I've never really been bound inside of a box where I'm only allowed to do these 3 things. And so that's what really brought me here, keeps me here, gets me to wake up excited every morning.
Nice. Well, that and your dogs, right?
They keep me up at night. They don't really help me.
Fair enough. I totally share a lot of the thoughts and the reasons kind of why you joined IFP and why you're there. We could look forward a little bit, say 3, 4, or 5 years out. Where would you like to see the firm? And where do you see yourself working on right now? What are a couple of things, the visions that you have, or a couple of projects that you see kind of coming to fruition in that time frame?
Sure. So that's, kind of a lifetime for me. But, ultimately, I think what we're working on is just expanding our affiliation models. So as I mentioned earlier, we were a hybrid RA with LPL. And so what we're trying to crack, and I don't know if it's ever going to be able to be figured out, but opening up our platform for hybrids as well. And so ultimately, there's a couple outside RAs that were with us and kind of rolled out and started their own thing that I still manage money for. And so, conceptually, it's not that hard to think a little bit further and say all right, can we open this up so you don't have to join our corporate RA? The problem is you end up conflicted if we do it the way that everyone else does it, where commission business and brokerage business, everyone knows it's a declining percentage of business mix. And so do you want to sign on and take a bunch of direct business mutual fund stuff where it's a big liability, a lot of books and records that you have to drag around for a decade? I think ultimately what we're trying to think through and, understand if it's even attractive to the market is just, can we be indifferent between the two to where we provide services and whatnot on both the RA and the broker dealer side? And essentially, the main, I think, difference in value proposition that we have is if you want to come and use us as an incubator, I think of it as like a staged approach. You roll out and you want to essentially become independent, but you don't want to start your own RA because it's just too much. So, join a firm like us, build your practice up, and then roll out, start your own RA, have a dual registration where you can still do some commission business. Because I do think that there are certain products and situations where commission just makes sense. It's cheaper for the client. And so I do think having both of those is good arrows to have in your quiver, more or less. And so I think what we're trying to just figure out and evaluate is there a way that we can be indifferent between the two? Is there a way that we can bring people and firms on, help them grow, let those firms then roll out, start their own RA? And then if they want to roll out and be completely independent and not affiliated at all, we are 100% great with that. And we're very friendly just because we've experienced kind of the other side of that. And so, aside from us looking at things a little bit differently, I think the main idea there is just being business friendly and letting you keep what you build with us and take it with you and make it portable.
Before you arrived at IFP, you spent some time at a firm focused kind of exclusively on high net worth individuals. Mm-hmm. We've all been in this business a while, and I think it's one of those things where you're working now may either be a stepping stone, or either way, the previous jobs and positions that we've had have all kind of added to our knowledge base. What is it that you learned there and helped you in your current role?
I was only there for a few years. It was the start of my career. And so I learned a ton. I started out in 2008. So the first thing I learned was, from a lot of mistakes that were made that were honest, just behavioral snafus, I guess would be the term. But, just little things that everyone kind of gets into, both clients and advisors. So I learned, right out the gate, some of the things, just, if you get a higher interest rate for something and, it's an alternative to money market, whatever it might be, there's usually some extra risk. And if you can't figure out what that risk is, then, you should probably avoid it ultimately. And so that was kind of the first thing. But in terms of like high net worth clients, I did a lot of planning. So I have my CFP as well as my CFA. And so I learned a lot about the planning side and all the different configurations and kind of components of wealth and sources of wealth. Since it was 2008, I had interned there for a year and a half before I graduated as well. And so I knew some of the clients and was able to see kind of what happened in '08, whether it was like restricted stock units where someone's entire CEO of a bank that'll remain unnamed, spending about $600K a year roughly. And that was like the financial planning assumptions, and all the net worth was RSUs. And so that was all predicated on the stock price of the bank being at a certain level. And so when '08 happened, the bank went out of business and all those RSUs were essentially worthless. And that was someone going from a millionaire, multi-millionaire to almost broke essentially, overnight. And so those types of things where it's just knowing about the sources of your wealth and making sure that if you're spending a lot, that you actually have some durability and it's not all contingent upon certain price targets being met and maintained. I also learned a lot of the services that I'm building on now, essentially to attract high net worth clients. I got the backbone and foundation from my experience there. So just essentially providing investments in kind of the purest access vehicles for things for whatever the investor is qualified for. So QP investors, qualified purchasers. I think that's a big focus of my time. And a lot of the services I'm building now are surrounding qualified purchasers and just getting them access to things that they qualify for, whether that's hedge funds, private equity. We're also building out custom 1031 exchanges. So for people that have a $1 million, 1031 and up, we'll go out and actually vet out properties and essentially do a individual customized 1031 exchange that we essentially split the commission with the advisor on. And so it's very hands-on. We can essentially find deals that are attractive to the investor because they might be an owner operator and they might have specific viewpoints that they want to express. And so we can help them do that. And we can also, match, make it so the terms line up. So you don't have to just put people into a DST or some off-the-shelf product that doesn't line up well. So a lot of what we're doing is just like very bespoke, custom-fitted investment solutions and things that we can do because of the amount of money that someone has. And so same thing goes for credit investors too. So, we kind of look at it as a multi-shelf approach where we have, different services and products and investments that are available. And some things aren't available when you go downstream because you have to wrap 10 wrappers around it and it ends up being too expensive to where you're better off with just traditional stocks and bonds and things you can get in ETF form. But yeah, did that answer your question?
It does. I want to circle back. You mentioned some of the 1031 and kind of helping clients out with real estate and stuff like that. I wonder if you could talk a little bit about that, just because I think that is an aspect that really kind of dovetails nicely into all the services that financial advisory firms can offer. Mm-hmm. I don't think a lot of people know that.
Yeah. So, ultimately I brought on a bright young guy from University of Tampa about a year and a half ago who his parents owned a self-storage business. And when he came on board, I let him essentially spend a lot of time hands-on helping them with their 1031 himself, because that was always something I wanted to build out. It was just, a very customized, bespoke solution that was different than what everyone else had out there. And so, I've let him kind of run with it and kind of learn from his own experiences and kind of things he did and didn't like about it. And so I've really let that kind of be the guiding light and let him run with it and build it out as another service that we offer. And it kind of goes hand in hand. We have a ability for advisors to refer investment banking business too. And we get a referral fee and we split it with the advisor. And we're just trying to build up this nice kind of suite of solutions. But yeah, 1031s is part of it. It's kind of cooled off a little bit, since interest rates have gone up and the real estate market's cooled down a bit. But, last year it was all pretty much anyone wanted to talk about.
This is great. I mean, you've given a number of examples. So you're trying to keep track of all these. So you're the CIO of IFP, you're the president of IFP Asset Management. You recently got engaged, which is exciting. Congrats.
Thank you. Appreciate it.
You're recovering from this encounter with your dog. You have upcoming surgery. So clearly you have a lot of spare time, right? A lot of extra time. So in all of that spare time, I mentioned earlier that you've taught yourself computer programming. So what started that interest? Like what prompted that direction for you? What are some specific applications that you use in your day job? Can you talk to us a little bit about that?
Yeah, I'd love to. So, what I did is I kind of maxed out Excel. I was trying to do kind of too much. And I started to look at it and I said, there's probably a lot more I can do if I just try to learn how to code. And so I'd always viewed, and I think what most people think is the same way I thought, I had friends who were like computer engineers in college. And I always looked at it like, wow, you must be so smart, and they are, but I always viewed it as something that's like way outside of my potential. Oh my God, I would have to go back to school to learn that. So I always kind of just like handicapped myself. So I just always kind of veered towards Excel. And then you start looking at Visual Basic and writing macros and kind of the code in the background. And so, I had built a billing app at the first firm I was at just to had my hands on a little bit of everything. But, they came to me and said, hey, you seem like you're good at Excel. Can you build a billing solution so we can automate our quarterly billing process? Because before it was, they were taking stacks of statements from Schwab and had someone going through and highlighting the balances and then transposing them, keying them into a spreadsheet. And I said, probably I'll take a look at it. And it kind of interested me. And I've always looked for ways to where I could have like an overlapping, something that helps the firm I'm at and also helps me, learn a new skill, even though it might be outside of what I truly want my career and kind of focus to be, it's worth it, I think, in my opinion. And so I've always had that kind of mindset. And so I built, it took me like 3 months, maybe, got Schwab to give us data downloads, which is a novel concept back then, but built out some macros and started to learn the Visual Basic coding stuff. And looking back, it was a freaking mess. And I would be shocked if that spreadsheet program worked for more than a year or two after that. But, it saved them probably 2 months of an employee's time per quarter. So I started seeing that and I was like, wow, this is like super powerful if I can harness the power of what I just did, but across RAs and the advisory space. At that time, there wasn't a lot of fintech, right? It was kind of ripe for, especially the smaller RA practices where, they have a little bit of technology savviness, but it's more on like the IT side, not so much on the programming side. And so seeing how that worked just kind of really got me interested. And I had always in the back of my mind been like, I should probably just learn how to code, probably started at IFP. And then maybe within a year or two, I started learning R, which is another kind of statistical programming language. And so I don't know why I chose that. I think it was just there's a lot of examples that I could, I'm kind of more, I guess, what an engineer would refer to as like a hacker learning process and kind of mentality. I'd kind of reverse engineer to learn and just see how other people are doing things. And so that's how I really started out, was with R and then Ruby. I didn't really know what I was doing. That's the thing, is if you don't really know how to install things and you spend most of your time initially learning how to install packages and, getting things to actually work. And so that's where probably a lot of the time was spent for me. It was just like hacking my way through. And, like I said, my dad worked for Hewlett Packard. So I was used to I didn't take any official computer classes or anything, but I was always going in and like just going into settings and like just doing, hacky type stuff and messing around with HTML code and stuff like that. But yeah, it really just started with a curiosity and just really kind of discounted myself and the ability to learn how to code. And so I started with Excel, Visual Basic, capped that out, and then, moved on to R. And then it took a while to, once you get over that hump, but started building out applications. And it takes a while until you can actually build stuff that is like actually useful. But after, a couple of years, I was starting to build out actual apps and whatnot. And so that's where, today it's teaching people how to code. I've probably taught 2 or 3 younger guys since I have been able to do so. And so that's helped me like really strengthen up and teaching them the way that I wish I would have learned, which is like keep things simple and just keep the setup minimal. Don't, because it just takes forever. And if you know certain things about operating systems, whether it's like better to be Windows or Mac or iOS, whatever you want to call it, that can make a difference depending on the programming language. And so I think just like spending the least amount of time. And so there's a lot of good developments since then that makes it even easier, like Google Colab, where you can just spin up what's called a Jupyter notebook without having to install anything. It's all in the cloud. And you can essentially just start writing code and executing in these notebooks kind of line by line. Yeah, if that was around when I started, it probably would have given me a bit more lift, but I would have learned a lot less about the actual setup, which is good to have, especially when you're launching apps on cloud servers. So it all kind of happens for a reason, I guess, and leads into my knowledge today. And it's pretty widespread. But yeah, I think, once you learn one language, it's pretty easy to start to learn all the other ones as well.
I would be remiss if I didn't ask, knowing what you know now, knowing where you're at and having taught a few people, what would you recommend if you could look back through all your knowledge and all your experiences? What would be, say, 2 or 3 things that you could recommend to somebody else who's looking to kind of get to be self-taught programming? Is it Python for Dummies? Maybe is it Google Colab? Where do you think would be a couple of different things that you could point out and go, for somebody who wants to do this, check out these 2 things?
Yeah. So, the way I learn is probably a bit different than, actually, I know it's a bit different than the majority of people. A lot of folks prefer the boot camps, the code boot camps and stuff. I have guys who've worked for me who, have had success with learning that way. I never did great in classroom settings. I was always just interested and I go at a different pace than everyone else. And so I get extremely bored and it's counterproductive for me. But I honestly, I see it a lot with the code boot camps. It gives you kind of like the illusion that you can code and then, you go out and try to do something on your own and you can't really because you don't have like the training wheels on anymore. And so everyone's taking those and they're popular. I think the best thing I would suggest is just you got to be hungry and just extremely interested in building and creating things that help you. And so starting to figure out what are some problems, I think that's where I really accelerated. It was just like, all right, what are some problems that I'm like real world problems at work that I'm dealing with, every day, whether it's, inconsistency with the way we're running our equity models or, consistencies with our tactical models, things like that, trying to solve and make those so they're essentially, ironclad and there's no human error and it's all just essentially rules based. That's a great place to start. Find something day to day that you do or that some people that work for you or work with you do that is just mundane and try to automate it. Just go home in your spare time and literally just go look at, open source code's a phenomenal invention. And so I think if that didn't exist, I don't think I would have been able to learn how to code.
So I want to dig into kind of the market a little bit. So you always seem to have a really good grip on what's going on in the market, leading trends and themes. You already mentioned that you don't watch the big publications, CNBC and the like. You like to kind of dig into the raw data more. Can you tell us a little bit more about that? Maybe at the risk of giving out some of your secret sauce, what publications do you like and trust that help you kind of construct your market view for your firm?
Yeah. So, the big thing is I like capital market assumptions for when I'm firming up, start of the year, more strategic thinking. And so, the JP Morgan capital market assumptions have been around for a long time and they really kind of dig into the actual details on how they arrive at their assumptions. BlackRock recently published more details around it and made a really cool interactive site. So those are the kind of the two pieces that I use to just see like 10, 15, 20 years out strategically, what's out there. I run, my own optimizers to roll like this capital market assumptions and run, hundreds of different iterations of what does a 60-40 look like if, I run based on JP Morgan's capital market assumptions with no constraints. What if I just look at what does the equity allocation look like if I run a max Sharpe ratio type of optimization routine? And, you get some pretty funky results. So, you have to end up, constraining optimizations quite a bit. And so it's just an exercise I like to go through annually when those come out at year end. So that's kind of more strategic thinking. The rest is really I use, St. Louis Federal Reserve, Fred website and API. So, it's all free data. It's phenomenal. I was kind of early trying to use data for investing and coding and all that. And so I remember when I was first starting coding, Yahoo Finance was like the free data source that everyone used. And there wasn't really a whole lot of options. And then one day Yahoo Finance cut the free data off and it was like, complete chaos in the quant investing world. And so, when that happened, then I'm sure it was true for everyone. I just looked at it and I was like, all right, I should just probably just start paying for data, being smart about it because you can rack up data bills real quick and get some nice recurring fees. And so like Quandl now, I think it's called NASDAQ data or something like that. It's a good place you can start playing around with data sets and whatnot. But I just like taking the data. And I think the biggest thing I've learned over the years is I started out trying to learn and know everything every minute of every day. And so that's, 24/7 having CNBC or Bloomberg TV on. And, what I realized is that it's better to know what not to pay attention to more so than what to pay attention to. And so I like just controlling my own flow, not dealing with headlines because it's just when we're talking about behavioral stuff and kind of my behavioral roadblocks and issues that I have, the headlines and kind of sensationalist stuff, it's distracting for me. And so I ultimately have a finite set of things that I look at and I don't let those change based on, a headline comes out that says X statistic is showing this and it's, there's always something new and some new way of proving, a bullish or bearish thesis. So I think it's like over time, just refining that and just staying true to it. And it's not to say I don't add new things to my arsenal every so often, but it's a long process and I got to have some proof and, show that it actually works over time. But I think that's the biggest thing. And I think in our industry specifically, and I'm sure it's true across other industries, everyone loves to just copy other people's work and charts. You see snippets of the same charts flowing through hundreds of publications and no one ever digs in and says like, maybe I should check that data and like try to replicate it and do it on my own. And so I still do that. If I see something that looks interesting, a chart or a stat, I go try to grab it myself and run the numbers and see if it's actually legitimate. And you'd be surprised in our industry how little of it that you can actually recreate and how many of these things make themselves onto mainstream media and just takes an extra, hour or two to just dig into it a little bit and fact check. And I guess it's probably the same thing with fake news that, globally that everyone's dealing with social media and fake posts getting reposted. And yeah, it's the same thing in our industry where people take stuff that has, issues in terms of just the way it was presented and correlations between things that aren't, legitimate. And I think that's where I focus most of my time, is just making sure and fact checking everything. And if something's legit, then yeah, I think I'll roll with it then and incorporate it into my daily flow. But that's kind of where I'm at on that.
Oh, awesome. So it sounds like you have a healthy skepticism of just the general broad market thought distribution, which is great. So do I. And then it does take some time to try to find that kind of nugget. Sometimes that person that kind of looks at the world a little bit different. What is what you perceive as just a general consensus market-wide view or portfolio allocation decisions? Could be something like 60-40 that you see or you talk to your colleagues across the country that is kind of in the norm, I guess, or widely held and believed that you disagree with?
I would say there's a top three for me on that. I think the big one that I always hear, and it's more so with clients in terms of like their fears and biases, is Europe's still, a big no-no for a lot of investors. That's, probably the number one request that I get from people when it comes to customization is like, I like what you're doing, but no Europe exposure. And it's all has to do with, Russia-Ukraine conflict. And, ultimately when everyone's on one side of a trade, usually the opposite happens. And so I think we're probably well into that playing out a little bit here, but that was probably my, number one thing, at least last year. And it didn't really have anything to do with the war and conflict over there, and more so just my experience with the imbalances of viewpoints and consensuses in our industry specifically. So that'd probably be number one. I think number two is probably just, and this is already playing out as well, but value stocks just globally. I mean, I think Dale and I might have been talking about this recently, but GMO put out some numbers on where they broke emerging markets, IFA and US through the Russell 1000 and quintiles by valuation. And so what was interesting is, in the US, the bottom, quintile, the cheapest stocks are, I think it was like the fourth percentile relative to their own history in terms of the valuations. And then all the other four quintiles were essentially very, very overvalued, even kind of that GARPy, growth at a reasonable price, very expensive relative to its own history. So to me, this still in IFA and EM, it was actually the bottom two quintiles were kind of the cheapest they've ever been relative to history. And then those top three were extremely expensive still. So I think the, consensus, I think, is still, on these like cool, growthy tech companies, which again, I'm not trying to paint a broad, stroke here, because I think there's differences between certain growth companies and tech stocks, but there's a lot out there that are still, I think, pretty overinflated, and kind of reminds me of, the dot-com bubble, which, we started out this podcast talking about it. It took about 4 years to play out until everything all the excess was kind of let out of the system. What are we like? We're about a year and 3, 4, 5 months in potentially. So yeah, I think value is still kind of my favorite, just global value, whether it's EM, IFA, US. I think that, it might be a bumpy road that doesn't, it's not going to be a linear value outperforming growth. But those 4 years after the dot-com bubble, it was value outperformed growth. And there was about 4 drawdowns that were pretty big for value in between, but it held up through that recession that we had in 2002. No one ever really talks about that recession. And so I think we could maybe be in a similar situation today where everyone forgot about all the value boring stocks. They want something that's super cool and makes, some new technology. And I think there's some legitimacy to it, but it's boring. And, I think that's why it works, but it'll take some time to play out. And I think the third kind of view that I have is just the S&P 500, the top 10, 20 companies is still way too overconcentrated. So I do think there's probably some antitrust stuff that's going to come through at some point where, maybe Amazon breaks up, maybe Apple breaks up. I think there's got to be some, something's going to have to give with those, let's call it the top 10 just to make it easy. So I've been veering away from cap weighted US equity indexes, the last year and a half or so, more towards equal weight, other weighting schemes. I like active management, but I think people confuse active management sometimes with alternative index weighting, ways that you can weight stocks with an index, right? And so I think to me, that's like a good middle ground between passive, which I think most people think of passive and indexes as market cap weighted stuff. And it's, if you want to build a low cost, bare bones, super cheap portfolio, cap weight your equity and bond, and you'll be at the cheapest in the industry. But you don't have to go full active. You can kind of step over and do equal weighted S&P and just do little changes here and there. I like that approach. And I think it's been pretty useful over the last year and a half or so.
Excellent. Well, listen, I really appreciate you taking time out to talk with us today. And one of the things we want to do, I guess we can call this Intro to Aaron Gilman in 60 seconds, or we can call it the lightning round. We want to kind of really find out more about you, kind of, what makes you tick and what you like. And so we're going to be asking you a couple of quick fire questions here, variety of topics. And only have a minute to respond. So if you want to say pass, fine, but we're going to fire them out at you. I think you've been, great so far. And, we're really happy to have you on board. So are you ready?
Let's do it.
Okay. Nickname?
Gilly.
Hobby?
Basketball, tennis.
Cats or dogs?
Dogs.
Best book about investing or finance?
Liar's Poker. I like that one starting out.
What would you be doing if you weren't sitting across from us right now and being an advisor?
Maybe an engineer or computer programmer, software engineer.
Favorite musical artist or band?
On my radio in my car, I listen to stand-up comedy exclusively. So I'm not a big music guy either.
Bucket list, travel destination?
Probably Fiji would be cool.
Hidden talent?
I'm actually really good at handiwork with myself in terms of my home projects and whatnot. So I know how to pretty much do electric and plumbing and all that stuff. Kind of self-taught as well. YouTube.
Office or remote?
Office.
Best lunch spot near your location?
I'm not a lunch guy, honestly. I work through lunch, typically just a little handful of almonds.
60-40 portfolio, a classic or a relic?
I think the concept are still true, but I'd say classic.
Would you rather have dinner with Warren Buffett or Elon Musk?
Oh man, definitely Warren Buffett.
How can people find you? Social websites? What's your website address?
So I'm a bit of a pariah in this regard. I have LinkedIn as the only social media I have, honestly. Yeah, I might have an Instagram account, but I don't even have the app on my phone. So it kind of goes in the same vein as not watching CNBC. I don't pay attention to social media either. I just do my own thing. And, I feel like things will take care of themselves. But my fiance handles social media. She sucks down enough screen time for the both of us.
Well, then fair enough. What is your company's website then?
IFPartners.com is our website. And then my LinkedIn is just Aaron Gilman. So those are the two spots where you can find me.
There you go. Perfect.
Yeah. Thank you for having me. Appreciate it.
Yeah, absolutely.
Thank you, man.
Thanks, man. Good to spend some time with you.
Thank you.
Whether you're a seasoned advisor or just getting started, the Active Advisor, brought to you by Harbor Capital, offers professional insights for the financial advisor community. Visit us at harborcapital.com to learn more. And don't forget to subscribe to the Active Advisor on Apple, Spotify, Google Podcasts, or wherever you listen to podcasts to stay up to date on investment trends, tried and tested research methods, and what your industry peers are up to. From all of us at Harbor Capital, thanks for tuning in.
And now for important disclosures. This material is for informational purposes and is not intended to be relied upon as a forecast, research, or investment advice, and is not a recommendation, offer, or solicitation to buy or sell any securities or adopt any investment strategy. The opinions expressed are as of 9th of March 2023 and are subject to change. The opinions expressed by the speakers do not necessarily represent the views of Harbor Capital Advisors, Inc. The information and opinions contained in this material are derived from proprietary and non-proprietary sources deemed by Harbor Capital Advisors, Inc. to be reliable and are not necessarily all-inclusive and are not guaranteed as to accuracy. This material may contain forward-looking information that is not purely historical in nature. Such information may include, among other things, projections and forecasts. There is no guarantee that any of these views will come to pass. This material may not be representative of the experience of other individuals. Reliance upon information in this material is at the sole discretion of the viewer. This material is not legal, tax, or accounting advice. Please consult with a qualified professional for this type of advice. Investing involves risk, including the risk of loss. Specific companies and issuers are mentioned for educational purposes only and should not be deemed a recommendation to buy or sell any securities. Any companies mentioned do not necessarily represent current or future holdings of any investment products. Harbor Capital Advisors, Inc. does and may seek to do business with companies covered in this podcast. As a result, listeners should be aware that the firm may have a conflict of interest that could affect the objectivity of this podcast. This material is prepared by Harbor Capital Advisors, Inc. Harbor Capital Advisors, Inc. is not affiliated with Capital Conclusions Corporation. All trademarks or product names mentioned herein are the property of their respective owners. Copyright 2023 Harbor Capital Advisors, Inc. All rights reserved.